Well, I have clients
Yeah.
that are, in other places. Nevada's nearby,
Okay.
and so I get a little bit involved in that. I'm not practicing law in Nevada, but I do have questions about that. And I know, for example, that Nevada is not, or until very recently, did not have an anti-deficiency statute.
Okay.
So it was what was called a full recourse state.
Mm-hmm.
So even people who bought personal residences had loans that were recourse. And so if you lost the property, the lender could go after you for a deficiency judgment. But if it was done by foreclosure, they only had 6 months to file a court case to recover that deficiency. However, I've seen recently that in the case of a short sale, because there's no foreclosure, the lenders actually have 6 years to come after that
Wow.
deficiency.
So
as
6
opposed to
months, 6 years. That's a
Right.
big difference.
So that's an example. That's Nevada, but
Uh-huh.
an example of how the rules can really be different and why people really need to be careful of what they're doing.
So you need to talk to really probably your local attorney,
Right.
real estate attorney.
Somebody who does
Yeah.
real estate.
Okay. What happens with second and third mortgages when you've got a short sale or a foreclosure?
Right. Well, in a foreclosure, let's call it a second. There's what's called a sold out second.
Okay.
So let's say that the house is worth less than the first mortgage, and you've got a first and a second or a home equity line of credit. The first is going to be maybe something you can resolve with the holder of the first mortgage, but you have to deal with the holder of the second mortgage as well, because when this thing forecloses, they're going to be what's called sold out, and they don't have any recourse at all, but they still have a note, and they can still sue you in court under that note. So you want to negotiate with them to try to work that out. Now, we're going to get into recourse versus non-recourse financing, but the difference is if it's non-recourse financing and if it's purchase money, both the first and the second would not be able to come after any deficiency on either one of those. So it depends on the kind of financing that it is, how these things are treated. But you have to be very careful with multiple mortgages.
Okay. So you talked about, maybe we should talk a little bit about that anti-deficiency for a moment. And
Right. In California, we have what's called an anti-deficiency statute. People also refer to this as non-recourse financing. And this is for personal residence, this is for acquisition money, for purchase money, and certain types of properties qualify. So each state has, not all states have anti-deficiency statutes, only like 12 or 13 states have them. California does. But for those kinds of properties, the borrowing, that is purchase money, is non-recourse. And what that means is the lenders can only go after the collateral, which is the property itself. They cannot pursue the buyer for any deficiency. If you refinance that mortgage, then instead of purchase money, it's no longer purchase money, and then it becomes recourse, and the rules change.
okay. So maybe we should explain then a little more detail about recourse debt and non-recourse debt, and how do you tell the difference?
Well, with most mortgages in California for residential property, you can't tell the difference because it doesn't say on the face of the documents it's recourse or non-recourse.
Yeah.
So it's because of that anti-deficiency statute that defines certain types of properties as not being recourse for the lenders that you have non-recourse debt in California. So it would be a personal residence and you're using the money to purchase that personal residence and you live in the property.
Okay. Okay, is a foreclosure or short sale of an investment property different from one for a residence or a vacation home?
Well, the commercial properties, investment properties, are not going to qualify under any anti-deficiency statutes. They're not personal residences. So you're not going to have non-recourse financing for those kind of properties unless the documentation itself says it's non-recourse. So it's possible to negotiate a loan with a lender for a commercial building and have them agree that it's non-recourse, but it would say so in the documentation. Other than that, it's not going to be. So that's the one significant difference. Okay. The other thing is there are some relief statutes that apply to the owners of personal residences when they have things like debt relief income, as you know, and that would not apply to those kind of properties either.
Yeah. Now, there's one of the things that distinguish a difference between short sales and foreclosures that you told me about is has to do with when they have a foreclosure that the lender is basically, if it's a first mortgage, that the lender is limited to the property or something. Can you explain that a little bit?
Yeah, what I mean by that is when you borrow money, the borrower has to put up collateral.
Yes.
In the case of a residential property, it's the property itself, the real estate. If it's your personal residence, that is, the property that you're putting up as collateral, then that means the lender cannot come after you for any deficiency if that property is foreclosed.
So that's whether it's recourse or non-recourse.
Right.
Then once they go in this foreclosure process, then they can only look to the property itself for satisfaction for a foreclosure.
Right. There are two rules that apply. There are a lot of rules, but the two main rules, there's something called the one form of action rule, which applies to all financing. And that's where the lenders have to go after the collateral before they can sue you. Mm-hmm. And then they can only sue you for deficiency if it's recourse financing and it's sold for less than the amount of the obligations.
Okay. Do you think it might be to people's advantage to declare bankruptcy as opposed to the foreclosure or the short sale?
Well, it's difficult to qualify these days for bankruptcy. So what I really think people should do if they're in this situation is talk to a bankruptcy attorney, not file bankruptcy, but get the information. I really think that's important because there are timing issues and there are also a lot of rules, and you would want to find out if you even qualify.
Yes.
But if you do qualify and you're going to be upside down and you're going to have damaged credit anyway, going through bankruptcy will eliminate the mortgages and eliminate any tax problems, which we haven't talked about yet, but there are income tax issues that pertain to this. And both of those things can be eliminated through bankruptcy, and they can't really be eliminated other ways except negotiation with the IRS, for example. If you have an income tax consequence from one of these things, you can negotiate with the IRS and show them you're insolvent and maybe get away from the tax that way. But the bankruptcy process covers all of that at once.
Okay. Okay. Well, we just have a couple minutes left. Maybe you have a few words of wisdom instead of getting into something that would involve a lot more detail as far as explanation.
I just think the most important thing is for people to try to get information about this process. There's an awful lot of stuff on the internet that's inaccurate. There's a lot of people trying to sell things, and what they're telling people is not necessarily true because they're trying to sell them something. So, it's hard to get good information, but the best thing people can do is become informed, talk to licensed people like the real estate people and their attorneys, and even in that realm, you need to talk with people who have had some experience with these kinds of things because the rules are very complicated, and each case is different. Each case, the little facts can make really big differences in each of these cases.
Okay. So related to that, I've had people call me. Now, of course, so one good source of information on how to find a good attorney is by calling your CPA. But also another thing, suggestion that I've had in many cases is if you've got a good real estate broker for the community, they're usually pretty well connected.
Right.
And so they should usually know who are some of the good attorneys that know about real estate that can help out. So that can be a suggestion. And then the other is the bankruptcy. Again, you might be able to ask that real estate attorney for a suggestion.
Right. But get the information.
Yeah, get the information. Okay, folks. Well, I hope this has been helpful for you in getting some basic information related to how short sales and foreclosures work and a little bit about loan modifications. And if you're having one of these, good luck to you. We wish you the best. Get good advice. And we'll see you next time on Financial Insider Weekly.